Chapter 6, Audit Planning, Understanding the Client, Assessing Risk, and Responding. To obtain an audit, the auditors may be asked to submit a competitive proposal that will include information on the nature of services that the firm offers, the qualifications of the firm's personnel, anticipated fees, and other information to convince the prospective client to select the firm. Arrangements for audit should be made through contact with the company's audit committee. The audit committee is composed of at least 3 independent directors who have no other relationship that might impair their independence. Fee arrangements will be made based on a per hour or per diem fee schedule for each category of audit staff. Then an estimated number of hours will be given to quote a range or bracket of amount within which the total fee will fall. The auditing standards require that successor auditors attempt to communicate with the predecessor auditors prior to accepting an engagement. Auditors should make inquiries of the predecessor auditor as noted in this slide. This communication is extremely important because it aids the successor auditors in evaluating the integrity of management and other issues related to the risk of the audit. The engagement letter should contain the name and address of the entity being audited, a section describing the objective and scope of the audit, including the financial statements and dates to be audited. Management's responsibilities are addressed, including their responsibilities for preparing the financial statements in accordance with the applicable financial reporting framework, establishing effective internal controls, complying with laws and regulations, making records available to the auditors, and providing written representation at the end of the audit. Last are the responsibilities of the auditor, including the auditing standards to be used, such as GAAS, Generally Accepted Auditing Standards, understanding of the client's internal controls to plan the audit, nature, timing, and extent of the audit procedures, limitations that are inherent to audits, and communications that are required by GAAS. Optional items that may be included in the engagement letter include the conduct of the audit, such as timing and client assistance, use of specialists or internal auditors, obtaining information from predecessor auditors, and fees and billing. If there are other services to be provided, such as an examination of internal control over financial reporting, then those should be addressed as well, as the limitation of or other arrangements regarding liability of the auditors or the client, and conditions under which access to the auditor's working papers may be granted to others. After obtaining a client, the audit process includes the following steps. 1. Plan the audit. 2. Obtain an understanding of the client and its environment, including internal control. 3. Assess the risk of misstatement and design further audit procedures. 4. Perform further audit procedures. 5. Complete the audit. And 6. Form an opinion and issue the audit report. This chapter will cover the first 3 steps. This diagram shows the 6 stages of the audit as well as the procedures performed in each of the stages. The different procedures that are included will be explained in this chapter and in the chapters in the remainder of the course. When the auditors have obtained a sufficient understanding of the client, they establish an overall audit strategy that considers those characteristics of the audit which determine its scope, such as industry reporting requirements, client locations, and the basis of reporting followed by the client. If the audit plan includes the use of the client's staff, then the auditors should obtain an understanding with the client as to the extent that the staff, including the internal auditors, can help prepare for the audit. When a portion of the client is audited by another CPA firm, efforts should be coordinated. If the CPAs lack the qualifications necessary to perform certain technical tasks, such as valuation of a diamond inventory, then planning should include the use of a specialist. In the first audit year, the CPAs will need to communicate with predecessor auditors, as previously discussed, and establish opening balances on the financial statements. The auditing standards require that auditors determine whether the prior period's closing balances were properly brought forward to the current period and whether those balances reflect the application of appropriate accounting policies. The required understanding of the client is used by the auditors to help plan the audit and to assess the risk of material misstatement at the financial statement and relevant assertions levels. To perform the risk assessment procedure, the auditors will make inquiries of management and others within the entity, perform analytical procedures, observe and inspect client activities, operations, documents, reports, and premises, and any other procedures such as inquiries of others outside the company, such as legal counsel, and reviewing information from external sources such as analysts and banks. Understanding the client's business and nature of the client involves understanding the competitive position of the company in its industry and the organizational structure of the company. What accounting policies and procedures have been applied by the client, and how the company is owned and what is its capital structure. What are the major product and service lines and what are its critical business processes. Also very important is information on the system of internal control. An understanding of the client's industry includes how competitive the industry's environment is and what types of supplier and customer relationships does the business have. Are there any new technological developments that may be putting pressure or creating opportunities in the industry? What major laws and regulations affect the client? Is the business subject to economic pressure? How attractive is the industry in terms of barriers to entry, strength of competitors, and the bargaining power of suppliers of material and labor and customers? Many firms, including the Big Four firms to varying degrees, have adopted a financial model to evaluate the client's industry. The client's objectives are the overall plans of the entity as defined by management. Management attempts to achieve those objectives by developing strategies or operation actions. However, achieving management's objectives is always subject to business risk. The auditors obtain an understanding of the client's operating and financing strategies and attempt to identify significant business risks faced by the client, because many of these business risks may create risk of material misstatement of the financial statements. Management may use a variety of techniques to measure and review performance, such as budgets, key performance indicators, variance analysis, and segment performance reports. Many firms have developed a balanced scorecard that uses a combination of financial and non-financial performance measures to assess the financial, customer, internal business process, and learning and growth perspectives of the organization. These measurement systems assist management in gauging progress toward meeting its objectives. External parties also may measure and review the client's performance. Auditors can use these same measures in designing analytical procedures to provide evidence about the fairness of the financial statements. Internal control is designed to provide reasonable assurance of achieving objectives related to reliable financial reporting, efficiency, and effectiveness of operations, and compliance with applicable laws and regulations. Before auditors can evaluate the effectiveness of internal control, they need a knowledge and understanding of how it works, what controls exist and who performs them, and how various types of transactions are processed and recorded, and what accounting records and supporting documentation exist. Much information about the nature of the client may be obtained through inquiries of management and other personnel. The AICPA audit and accounting guides and industry risk alerts, as well as trade and government agency publications, are useful in obtaining an orientation to the client's industry. Previous audits, annual reports to stockholders, SEC filings, and prior year's tax returns are excellent sources of financial background information. The Internet makes any number of sources of electronic information available about clients, particularly clients who are public companies. Another useful preliminary step for the auditors is to arrange an inspection tour of the plant and offices of a prospective client. Analytical procedures can provide information to understand the client and help to identify areas that may represent higher risk. The auditors may use the statement of cash flows to analyze cash flows while obtaining an understanding of the client, particularly as part of risk assessment analytical procedures. The concept of materiality recognizes that some matters are important to the fair presentation of financial statements while others are not. Materiality considers both quantitative and qualitative factors. Under certain circumstances, a misstatement that would ordinarily be considered immaterial in quantitative terms may be material because of its nature. As an example, an illegal payment of an otherwise immaterial amount could be material if there is a reasonable possibility that it could lead to a material contingent liability or a material loss of revenue. Auditors consider materiality both in planning the audit and in evaluating audit findings. In the planning stage, the auditor considers the materiality at the financial statement level and then allocates the materiality to the individual accounts. The FASB and PCAOB definitions of materiality are shown in this slide. Materiality judgments depend both upon the financial reporting framework being used and on the auditor's professional judgment. GAAP refers to the FASB definition, while the PCAOB definition points to the interpretation in the federal securities laws that the Supreme Court in the U.S. has held to determine that a fact is material. The auditor should plan and perform the audit to obtain reasonable assurance that material misstatements, whether caused by errors or fraud, are detected. Accordingly, in designing an audit, the auditor should identify and assess the risk of material misstatement of the financial statements. By asking what could go wrong and how likely it is that it will go wrong and what are the likely amounts involved, the auditor can assess risk. In particular, the auditors want to consider the inherent risk and risk of material misstatements due to fraud. After assessing the risk, the auditor should design further audit procedures. The auditor's consideration of risk of material misstatement from fraud recognizes that there are two distinct types of fraud: misstatements arising from fraudulent financial reporting or management fraud, and misstatements arising from misappropriation of assets or defalcations. The audit team is required by the standards to have a discussion about the susceptibility of the client's financial statements to material misstatements, including a discussion on susceptibility of fraud. The PCAOB standards emphasize that the communication among the team members about significant matters affecting the risk of material misstatement should continue throughout the audit. Procedures that are used to assess fraud risk include making inquiries of management and other personnel, performing analytical procedures, and considering risk factors that provide incentives, an opportunity to commit fraud, and/or an attitude that allows the individual to rationalize a fraudulent act. Auditors may modify their overall approach to the audit in response to fraud by designing procedures to obtain more reliable evidence and using more skepticism in examining evidence, assigning additional staff with specialized skills, knowledge, and experience, deciding to further consider management selection and application of significant accounting principles, particularly those related to subjective measurements and complex transactions, and incorporating an added element of unpredictability in the selection of auditing procedures. If management override is suspected, then the auditor may examine journal entries and other adjustments for evidence of material misstatement due to fraud, review accounting estimates for bias, and evaluate the business rationale for significant unusual transactions. The auditor's concern about fraud does not stop at the planning phase of the audit. Throughout the engagement, the auditor should be alert for conditions that may indicate that a fraud was committed. If auditors discover fraud, they should evaluate the implications of the fraud and communicate their suspicions to an appropriate level of management, at least one level above the level involved. If the fraud involves senior management or material misstatement of the financial statements, the matter should be reported to the Audit Committee of the Board of Directors. The auditor's selection of further audit procedures is based on the materiality of the account balances, transactions, and disclosures being audited, and the assessed risk of material misstatement. The types of audit procedures include test of controls, analytical procedures, and test of details of transactions and balances. Audit procedures include inspection, observation, inquiry, confirmation, recalculation, and reperformance. Designing further audit procedures is a critical process that involves complex judgment to link specific audit procedures with the assessed risk at the relevant assertion level. Tests of controls are needed when the auditor's risk assessment includes an expectation that controls are operating effectively, or when substantive procedures alone do not provide sufficient appropriate audit evidence. All auditors on engagements, but particularly those working in high-risk areas, should apply a heightened degree of skepticism. In staffing the high-risk audit, the firm should consider assigning more experienced staff, individuals with specialized skills, and increasing the extent of supervision for the engagement. For the risk assessment, the auditor should document the discussion of the audit team concerning the risk of material misstatements due to error or fraud, the key elements of the understanding of the entity and its environment, and the assessment of the risk of material misstatement at both the financial statement level and the relevant assertion level, and the risk identified. After procedures have been performed, the auditor should document the overall response to address the assessed risk of misstatement, the nature, timing, and extent of further audit procedures, linkage of the procedures with assessed risk, and the results of audit procedures. With respect to the auditor's consideration of fraud, the requirements are similar. The documentation should show the discussions, procedures, risk identified, and response to the risk. An audit trail consists of source documents, journal entries, and ledger entries in a manual accounting system. An audit trail also exists within a computer-based accounting system, although it may have a substantially different form. Auditors may follow the audit trail in either of two directions related to the direction of testing. Testing for existence or occurrence starts with the accounting records and goes back to the source document. This is called vouching and test for overstatements. Testing for completeness starts at the source document and ends at the accounting record. This is called tracing and test for understatements. This diagram illustrates the concepts of direction of testing, either from right to left, which is for existence or occurrence, or from left to right, which tests for completeness. A transaction cycle or class of transactions is a sequence of procedures applied by the client in processing a particular type of recurring transaction. While they differ from company to company, typical cycles include the revenue cycles of sales and collection, the acquisition cycle of purchases and disbursements, the conversion cycle, which includes production, the payroll cycle, investing cycle, and the financing cycle. This slide illustrates the transaction cycles that affect accounts receivable. This figure also illustrates how sales returns and allowances and write-offs of uncollectible accounts affect the accounts receivable account. The audit plan contains two major portions. The systems portion, which involves an understanding of and assessment of the effectiveness of the client's internal controls, and a substantive test portion that deals with procedures aimed directly at financial statement account balances and indirectly verifies income statement accounts. This chart illustrates the auditor's approach to auditing financial statement accounts. Most audit firms organize much of the substantive portion of their audit plans around the balance sheet accounts. Then they complete any additional procedures needed to substantiate income statement accounts and information in the financial statement notes. An advantage of this balance sheet approach is that highly reliable evidence generally is available to substantiate assets and liabilities. As shown in this illustration, if the auditors are able to satisfy themselves that all cash receipts and all changes in accounts receivable during the year have been properly recorded, they have indirect evidence that revenue transactions have been accounted for properly. This diagram illustrates the relationship of financial statement assertions to the audit. The audit procedures contained in the audit plan are designed to be responsive to potential misstatements in the financial statements. To make sure that the plan addresses all potential misstatements, auditors often develop audit objectives for each significant account balance and class of transactions. These objectives follow directly from management's assertions that are contained in the client's financial statements. From these assertions, general objectives may be developed for each major type of balance sheet account. This diagram illustrates the relationship among audit objectives, risk of material misstatement, and audit procedures for the audit of accounts receivable. This figure includes examples of identified risks related to each audit objective and one procedure to address each risk. Usually a greater number of risks are related to each objective, and several procedures may have to be performed to address a particular risk. It is important to remember that the audit plans presented throughout the textbook merely illustrate typical procedures. In actual practice, audit plans should be tailored to each client's risk and internal controls. Audit procedures may vary substantially from one engagement to the next. And that is the conclusion of the presentation for Chapter 6.